Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. As always, we need to remind you that trading is a risky endeavor and not suitable for all investors. I wrote the book The Secret to Trading, Risk Tolerance Threshold Theory. We're getting great reviews on that, great feedback on that. I actually had a gentleman tell me, he said, "Yeah, I see your book is selling very well." I said, "Oh yeah, thank you very much." He said, "Yeah, I got it. I love it." He said, "I'm a little bit concerned it's selling so well, though. I don't want anyone else to have it." He's worried that it may not work anymore. I don't think that'll be the case. These markets are too big. That's about that. I mean, it's a neat overview of how we categorize the patterns in the markets and how we choose which markets to trade. And I think it's pretty effective, but I don't think we have to worry that it could change market behavior to the degree he was talking about. But let's get right to the charts. As always, we're going to start with the Australian dollar first. You know, you really had a meltdown in the Australian dollar, and it's not without precedent. In fact, you did the same thing this same time last year, so I was a little surprised. Last year when you did it, forewarned is forearmed. This time, to really see the big picture, we need to go out to a weekly here. And you can see there's plenty of room above in the Australian dollar. I think the big difference for me this year as compared to last year, and I think for a lot of traders and analysts also, is that it never comes as a surprise, as big of a surprise the second time, right? But even more so now, I think we have more clarity in the commodity markets. There's no doubt about it that the Australian dollar is reliant on that commodity economy as far as all their minerals, etc., and everything that they sell to China in that regard. So last year we weren't quite sure of what to make of it, although I guess that was kind of a shot across the bow for slowdown commodities. Now it's not too big of a surprise because you actually are seeing a slowdown in commodities, and we're going to cover commodities later too. In this broadcast, we're going to cover those long-term patterns and show you how significant they could potentially be too. So we see some more downside in the Aussie. It'll be interesting to see it stabilize. If it stabilizes above 95 even, which we would expect. I think overall there's an outside chance that you see the 90 handle at some point over the next couple of months too. So no doubt about it with the momentum down on it. The Aussie, not only, we've been day trading it from the short side, but, this really opens up the door to swing trading, even position trading on the short side. And that's not something that's been the case for a couple of years in Aussie. So we think there's at the very least, there's some more downside down to probably 95 and a little bit longer term, probably down even to closer to the 90 handle. Next market, the euro US dollar. I think there's more downside here. Well, you're looking at the chart 126, but I think you've got further downside to go there too. I think 120 here, and if you want to see how these markets have been reacting, the big moves you're seeing. First, you look at the pound. You had the complete collapse of the pound earlier in the year. Now you're seeing the same in the Australian dollar. I would think that you'll see the same in the European dollar. And to me, the reason why the currencies tend to be collapsing against the U.S. dollar is one of not necessarily dollar strength, but one that the U.S. is definitely closer to the end of the QE period than anyone else is, only because they started it first. This is not to say that the U.S. economy has to continue to put up good numbers. This is not to say that the European economy has to continue to put up bad numbers. This is not even to say that we're closer to a sustainable recovery. What we're saying is the U.S. is further along in the QE process. That zero interest rate policy is certainly going to drive your interest rates lower just by default. If other economies, other areas of the globe are going with the QE now compared to having gone with it earlier, it's an easy assumption to make that the U.S. is further along in it. Therefore, by default, they're closer to the end of it, which is not to say that the end is any closer, but they're just further along with it. So we think there's more downside in the euro almost by default. We think 126 will be a level we'll see. And it goes back to last summer when we thought we'd see 119. 120 was our target. You didn't quite get there. And then you had the Draghi rally here, but we think you're back on track to see that. So we think you'll see lower levels in the euro. And again, here's the big tip-off. If you're not sure that these currencies have further to go, just look at the yen. Look at how powerful the yen's been. The yen 100 was our upside target for the longest time. You eclipse that 2 weeks ago, and it's still cooking higher. So I think you get 106, 107 out of this guy now before potentially you get a correction. So there's plenty of room once these currencies get rolling. And I think the euro, a bit of a laggard on the downside compared to the pound, compared to the Aussie now. But I think it could catch up, and once the currencies get rolling, we're seeing it. They tend to stay rolling. So more downside in the euro and Aussie, and probably a little bit more upside here too. Dollar again has been a fantastic trading vehicle short term. There's just no doubt about it. Intraday short-term traders have just been having a good time on the long side here. And currencies overall, they're just a great trading market. They're great for that. Let's move on to the commodities. Gold gets a lot of press. Here's long-term gold. We'd have to go out to weekly to give you scale here. There it is. That was our initial downside target from the collapse, and you got it, 1340 or so. We think that, realistically, 1100 it will be your downside, but 1300 you'll probably have some support there. So you have pretty good support between 1300 and 1100. But yeah, we see 1100 near term anyway. When I say near term, over the next couple of months, the momentum is just down so much here that awful hard to turn this guy around. And you could see easily, if you eclipse that low there, you'll see another panic. So commodities, we think they've turned the corner. If you look long term here, it's easy to imagine more downside. So 1100 we see in the gold. These commodities are in a very interesting position. Even the grains, which have been holding up. They've been pretty stubborn, and I think that's a function of energy prices too. Hey, it takes a lot of gas to fill up these combines and get the grains planted, and then you can imagine to harvest them too. So no doubt about it, as long as energy prices are going to stay high, no doubt about it, farm products are too. But here's the corn chart. Here's a weekly corn chart, and you can start to see that potential shift here where you had the huge spike in 08, 09, and then the two droughts in 2011 and 2012. Yeah, I'm not saying that grain drops right back down to $2 where it was in the good old days, right? Earlier in the previous decade. On the other hand, just looking at the chart alone, and if we just get a continued normal spring, you may finally have broken the back of this great bull market too. So potentially lower prices here. This is corn. So potentially lower prices in the grains, and I think the U.S. economy would certainly welcome that. Now here's the fly in the ointment. Crude oil. Here's your long-term crude chart. Well, it could be worse, right? Here, I'll show you to you on the daily, where this was a little disappointing in that you had the crude on the run, and they just couldn't put the boots to it. They let it off the mat, and now you're seeing it trying to recoup gains. As long as crude stays below $100, I think you're okay. If it breaks above $100, that's not going to be pleasant. The economy doesn't need that. Really, the economy needs to see lower crude oil prices, not higher crude oil. But if you look at the big picture, you do have a pattern of lower high, lower high, lower highs. They need to keep this guy below 100 though. If somehow you can break the crude market now, if you can break the back of the bull in the crude market, that would be just what the global economy needs. Just what the U.S. economy can benefit from the most right away, and definitely what the global economy could use overall. So this is going to be the market to watch. If crude oil stays high, those grain prices are going to stay stubbornly high also. And it's going to be real tough to see any kind of GDP growth close to what we've seen. You're almost 3%. You're in the mid to high 2% range of GDP. You're not in the U.S. That is, you're not going to maintain that unless you can knock these crude oil prices lower. So we need lower crude oil prices, not higher. So this is definitely a market we're going to watch for. Let's see if it holds below 100, and then you can maybe swing it lower and get this guy back down towards 2010 prices. Boy, 70 would be great. 70 would be what the doctor ordered for the economy. Let's take a look at copper. That's another important commodity bellwether too. And here you're getting a little bit better picture. They knocked it down pretty good. You got it down to $3. Overall, I think that the massive building that we've seen, not just globally, but locally in the U.S. too, you're seeing pretty good housing numbers. I don't think. Well, I think they're that's normal. It's not to the accelerated degree it was in the past. So I don't see that putting that much upward prices on copper. But I think lower copper prices overall wouldn't be a bad thing because it would point out that lower commodity prices overall at this point in the cycle would be a good thing. Let's take a look at the U.S. stock market and we'll wrap it up. Here's the U.S. stock market. If you look at it short term, it's a runaway bull, right? Now, if you pan out, this is even a weekly chart that's a runaway bull. If you pan out to a monthly chart, and this is what we've been focusing on for a good long time now, that basically this market's been in a sideways market for 13 years. So essentially you're breaking out of the sideways market. Yes, if you look at it on a daily chart, you think, wow, that's a bubble. This market needs to correct. It needs to do something. They have to slow it down. It's dangerous. On the other hand, when you look at the monthly pattern, it's a normal bull market. You had a big bull market. It went sideways for 13 years now. It's breaking out on the upside. So you pan out and you get that bit longer term perspective. This is not such a big deal, right? In fact, this may be highlighting that we are, in fact, seeing a turnaround in commodities. Potentially, the stock market may be pointing out that we are going to see lower commodity prices, not higher commodity prices, and that would be with the doctor order for the economy. But we'll have to see. For now, however, stocks may be getting a little bit ahead of themselves, especially when you look at it on a lower time frame, such as a weekly or a daily, because the crude oil hasn't turned lower yet. So I think if commodities do turn lower, that will confirm this breakout in the stock market, and again, I think we'll continue to see a strong U.S. dollar going forward. If you want to see what's happening at Trading University, you can go to our site. You can come check out the site. Click on our blogs, our Trading U blog, our Seeking Alpha blog, the video commentary, which you can access this video commentary. If you want to come see our courses, you can always click on live market analysis, and you can see me highlight setups and signals in live markets actually this Monday. So if you sign up for our live market analysis trial right there, we'd be happy to meet you in there, and we can show you what we do on those lower time frames. Also, if you want to get a jump on it, you can always go to EOS Trade also, where clients of ours who have live Forex or futures accounts can receive a portion of that master's program for free if you open up a live account at eostrade.com. Hey, thank you so much, and we look forward to seeing you next time.